our last company for today, and that is RAM Essential Services Property Fund. The ASX code is REP. RAM has a market cap of around 388 million. RAM Essential Services Property Fund is an Australian real estate investment trust which invests in high-quality Australian medical and essential retail real estate assets leased to essential services tenants. Today, we welcome Matthew Strotton, Executive Director and Head of Real Estate. Matthew, take it away.
Thanks, Manny. Thanks for having me. And it's a pleasure to join the panel today. Some very interesting companies and presentations. If we move into the second slide here, this gives just a very high-level snapshot of the group. That's a great introduction, Manny, to who we are and what we do. We are a real estate investment trust, which is a portfolio of direct real estate. Within the portfolio, we have 35 assets. Those assets are focused on two sectors, the healthcare or medical sector, as well as what we call essential retail assets. These are the types of retail assets that have a supermarket and carry with you your daily or weekly shopping needs that are typically located within your local community. At the other end of the spectrum, medical assets comprise, on balance, private hospitals, private day hospitals, as well as allied healthcare, which again form part or the nucleus of most local communities around the country. Our objective is to provide investors with a stable and secure income. Drawing on both of these sectors, you noted our net asset value, the gross valuation for the vehicle is at just a little under 800 million. And it is managed, as pointed out, by RAM, which is Real Asset Management, with our teams located across the east coast of Australia. So if we move into the next slide, this gives a high-level snapshot of the asset profile within the vehicle. You can see there is a concentration on the east coast. We do have a small but not unreasonable exposure to WA and a small number of assets located up in Darwin. But the portfolio, as I said, comprises about 50-50 in terms of income exposure between the healthcare or medical asset class and the essential services retail asset class. So if we move on to slide 3 or the next slide, it's a delight to talk to you sort of broadly about the group today, but I'm also pleased to call out the recently published results from our new 2023 results, which occurred about a week ago. Just sort of working down from the top there, one of the highlighted outcomes for the portfolio is quite strong leasing spreads. These are the review profile for both existing as well as new lease deals across the portfolio. And in most operative or descriptors for groups around the country, if that can be at or above CPI, that is going to be a very good outcome for the year. I'm pleased to say that across both new deals and renewed deals, we achieved a 5% leasing spread across 58 deals. That's within a portfolio of a little over 300 tenants. Our tenancy mix is well let. We have a little over 98% of the portfolio is let, it's leased, which means we draw on a contracted income. And on the earlier slide, the average duration of the portfolio is just approaching 7 years of contracted lease income across the portfolio. It sounds a little bit like this is a core or an in-place portfolio, but there are opportunities within the portfolio for RAM to develop assets on behalf of the vehicle. These developments in this particular environment are something that we may or may not draw upon. As most of our listeners would probably understand, it has not been the most straightforward of years in terms of interest rates, and the same applies to the level of certainty that we can deliver on our developments. But importantly, we have a portfolio where we can either push out, delay, or revisit the scope of those developments, and that's what we've been doing, focusing instead on drawing out far more positive outcomes on leasing. At a financial level, the portfolio has performed very well for the year. We achieved NOI growth of 4.5% and met our guidance, which was 5.67 cents per share, which was around an 8% yield at 30 June prices. So a very attractive in-place yield. The WACR, which is the weighted average cap rate, moved further outward. This is the average cap rate that is ascribed to us by third-party valuation firms. We don't value our houses our properties in-house. They are done by third parties at arm's length. And not surprisingly, we have seen cap rates across all real estate sectors move further out this year. What I will, and I'm very, very pleased to point out, is the two sectors that we focus on, healthcare and essential services retail, have been significantly immune to the movements in cap rates to some of our other sectors, in particular the office sector. We have set a guidance for our earnings for next year, for financial year 24, which is around the same level, which when we translated that to our investors in our presentation week, was received very, very well. And again, looking forward on current pricing, that is around a dividend yield of 8% for the coming year. In terms of the activities we'll be working on, we'll be focusing on managing our debt positions and ensuring that our current headroom is maintained, and we continue with an average leverage of between 30 and 35% based on those underlying values. We are comfortably within those limits at the moment and are working on activating value within the portfolio by disposing select assets, which we have done to date. As at 30 June, we had one asset under unconditional contract, and as of yesterday, that was announced in the press. We're very pleased with that momentum, and we expect to continue doing that and putting that capital to work in a couple of initiatives, which I'll talk a little bit more about. So if we move through to the next slide, this is really calling out the type of manager that RAM wants to put forth to its investors and demonstrate quarter after quarter. In the 23 financial year, very strong positive leasing outcomes for the vehicle, which was testament through our NOI growth for the year. We met our expectations and continue to deliver on behalf of our investors. We've expanded our syndicate lenders. So what that means, we have two large lenders that effectively lend across our portfolio, which gives us flexibility to operate and develop our assets whilst we stay comfortably within debt covenants. These are covenants like an interest cover ratio and so on, which we follow very closely and naturally are staying well within. We are continuing to work on maintaining or optimizing the portfolio value through capital recycling into 24, and feel very comfortable improving out our valuations and being able to move on those initiatives, unlike some of our peers who are not as relatively well weighted in terms of current valuations. If we move through to the next slide, this is just a snapshot of the management team. The group was founded by Scott Wheel and the Australian CEO is Scott Kelly, two ex-UBS professionals. Myself running the real estate group, and David Grosser recently joined the firm as the group CFO. My group leads based across the East Coast and invariably lead up all of the product across the real estate group. So on slide 6, again, just a recall of exactly what it means to invest in REP. The healthcare sector and the essential services retail sector have proven to be the most defensive and resilient real estate asset classes through some of the most extreme stress tests, certainly in recent history. Throughout the pandemic, as you might imagine, healthcare has held up reasonably well, despite the level of procedures that are being required by our communities being pushed further out due to the medical needs required through the pandemic. Notwithstanding that, our portfolio and cash collections was very high through that period. And non-discretionary retail, this is the type of retail, again, that is led by supermarkets, that is led by the types of retail that will be continued to be required by households, almost disregarding what level of economic activity we're experiencing. And again, going through environments that we did through the pandemic, it held up extremely well. Now, not all sectors can advertise that level of defensiveness, and it's something I'm very pleased to point out. If we do, in fact, go through a period where households are, like we are today, continuing to experience a level of weakness, then these are the two sectors in real estate that I would highly encourage you to focus on building out a long-term sustainable allocation to. Our valuations have remained solid, and we benchmark very well to our competitors. These sectors, as again, have been pointed out by our external valuers as being more resilient, and that's demonstrated by being able to dispose or transact on assets at valuation. We are an active manager. We don't sit on our hands. We are always looking to extract value both from a financial perspective as well as adding value or redeveloping our physical assets. And that's something we'll be looking to do more in 2024 and beyond as our financial and capital markets start to improve. We move on to the next slide. So I'll now walk through these relatively quickly. This is calling out some of the financial and variables from our 2023 results. Sorry, move on one more slide. Hello? One more, there we go, thank you. And just sort of walking through the page, again, 35 assets within the portfolio with a gross portfolio value of a little under $800 million. Our weighted average cap rate is 5.68%. And if you look down the bottom right-hand chart, you can have a look at the type of lease profile that is demonstrated across that portfolio, an average of just on 6.5 years. 301 tenants where the mix between our portfolio is around 50-50 spread by income. Next slide, please. Again, another little snapshot, 98% occupancy with 4.5% NOI growth for financial year. And underpinning that, not surprisingly to most, we've experienced very strong supermarket MAT, which is our sales or turnover growth as reported by our supermarkets. And we share in a portion of that growth as part of the revenue through to investors within the vehicle. So again, it's been a very, very important part of the results for the year. Moving further again, please, onto the next slide. This is a short summary of the valuations, our third-party valuations. And sorry, next slide. And how we benchmark. What I will specifically call out, while we have an average cap rate of 5.68% for the vehicle, that is attributed to medical at 5.49% and 5.84% for our essential retail exposure. And on the bottom right-hand side, you can see where we benchmark to our two peers in healthcare. We're very, very well positioned, and likewise in the retail sector. What that means from our perspective, if we are talking about recycling capital in the coming year, selling assets and putting that capital to work in perhaps more favourable or attractive acquisitions, potentially through a share buyback or simply to pay down our debt position, we are in a far more attractive position in order to do that. We can talk about initiatives, then we can execute on initiatives, and that's what we fully intend to do. And we're doing that from a more attractive benchmarked position. Moving on to the next slide, please. This is again calling out some of that activity. I mentioned we've gone unconditional on an asset, which was reported in the press yesterday, as well as putting capital to work towards the more prudent average managing of our leverage or debt position, as well as redeploying into new acquisitions or possibly a share buyback. Next slide, please. We called out, or actually called out a spotlight on healthcare. One of our group's initiatives has been to invest more heavily in being able to both identify, source, and deliver upon a range of risk assets in healthcare. Most of us sort of sitting around contemplating what might be an investment in the vehicle. Healthcare remains one of the most underserved in terms of a supply perspective in the Australian real estate commercial environment. And at RAM, we've been investing in terms of building up our internal capabilities, not only to source properties, but importantly, to be able to develop healthcare assets. We're now focused on building a far greater level of understanding and enhancing our relationships with our existing operators, our existing hospital operators, in order to be better positioned to provide development solutions. And doing that over the last 18 months has come to a point now that we are working with one of our largest private hospital providers to execute on two expansion schemes at two of our private hospitals. It's something we fully plan to continue And those dividends, in terms of identifying new opportunities and placing the portfolio in the position to acquire new and attractive, well-led healthcare stock, is something we fully intend to continue and amplify our resources on. Next slide, please. Just calling out and having a look ahead for the next year, again, what it means to invest in the RAMS Essential Services Property Fund. We are looking at a distribution that equates on our prices at very close to an 8% distribution yield. We've maintained an FFO payout ratio of between 90 and 100%. In fact, we're very close to between 96 and 97% on a consistent basis. We are very excited about the future, at least of which because our house view is that the interest rate cycle is most certainly coming to its near-term peak. And what that means for real estate in general is a higher level of certainty on the sustainable level of income that can be produced. We feel very strongly about that coming about, but most importantly, because the income that is derived from our portfolio is being derived from two defensive and resilient sectors, healthcare and essential services retail. But with that, Manny, I'll wrap up and open the floor to questions.
Thank you, Matthew. And there are a few that have come through. I might start with the first one being obviously your assets. You make that pretty clear. Are pretty defensive, and as a result, you're quite confident that those valuations are well supported in your particular portfolio. But there were a couple of questions asking about the current asset backing versus the price of the stock, and the discount there, which I don't think that's not unusual in this market. But
yeah.
Do you have any strategies in place? Is the board looking at how you might be able to close that gap?
It's very good questions front of mind for me most days. Absolutely. We did experience a little bit of duress in our price because, unrelated to the outlook for our portfolio, one of our larger investors had to reweight during the year, which again is not surprising when the REIT sector goes through such expansive moves, which has been led by interest rates. And again, something that impacted us. I also firmly believe that the listed market, the pendulum has swung just that little bit too far, and we are starting to see that normalise, combined with the fact that we are still a relatively lightly traded stock. I think what you're asking there, Manny, and what is the board looking at, led by the manager, is how can we build scale, effectively become a far more actively traded stock, and in effect aim to become part of the ASX 300. Those are the overriding objectives for the vehicle. We want to put ourselves in the position that we can firstly trade far closer to NTA, which we're working on and are quite pleased with our progress over the last 3 months. And importantly, put ourselves in the position where we can actively entertain or pursue what might be a range of growth initiatives. They may well be larger scale developments, or more importantly, a potential portfolio or single asset or portfolio transaction that we can marry into the vehicle in a comfortable way and be able to prove significant value uplift to investors. So growth is definitely our objective. We're not doing that at the expense of earnings. It is vital, and it's part of a hallmark of the group to maintain a consistent and sustainable yield from the stock, but working actively in the sidelines, preparing the group to start to scale up. So that is well and truly the objective for the group.
Okay, great. The next question is around discipline, and it's essentially how are you stopping yourself from overpaying for some of these defensive assets, healthcare assets, which are clearly very sought after in that space? How do you control that? How do you make sure you don't overpay?
Great question, Manny. It was something moving into this cycle. I mean, most of us had a view we were going to be experiencing some interest rate rises that would then in turn be followed by some cap rate declines and pricing weakness and capital market declines in demand. And it was we had a range of opportunities to pursue around 12 months ago. Moving into the cycle, we sat on our hands. It was quite a deliberate move by us to just sit and wait, play defense rather than offense. But equally, and at the same time, as I alluded to, we focused a lot more on building the resources in-house, not to go and pursue those 4 and 4.5% healthcare assets, which we still are very drawn to. Rather, we'd be pursuing a program where we can actually build those opportunities. So building rather than pursuing, and certainly competing in quite a fierce environment for those assets. We're now looking at a more expansive program to be able to build those opportunities. In time, we are looking to do the same in essential services retail. We won't be doing that across the portfolio. We'll be marrying that development risk into the portfolio on quite a careful basis. But being able to do that means we're not paying what are some quite aggressive cap rates in that, as our question asker pointed out, in quite an attractive and desirable asset class.
Yeah. Okay. And just one last one, and this one's around gearing. The gearing did sort of, move up a little bit over the recent period, but you have said you're quite comfortable where that is.
Mm-hmm.
Do you anticipate bringing that gearing level down a little bit? And number two, do you hedge your gearing is another question that's come through.
Yeah, yes and yes. As pointed out, we hit sort of about 36%. We're now back down to 35 on the closing of our recent transaction. We have 3 other assets under diligence, 2 of which by mid next week we will know if they have gone unconditional. The immediate objective for that capital is to reduce debt. So we will actually be just back below under 33% in the very near term. Our objective is to stay like we have, sort of in that 30 to 35% range. I think it's keeping that level of flexibility as we pursue both new acquisitions and developments is important for us. And yes, we do carry a hedge profile for the vehicle. We're around 56% hedged at the moment, and our longer term or tactical plans for hedging is to stay between 50 and 75%, and we will be staying in that range.
Okay, excellent. Thank you very much, Matthew. That was
My
great,
pleasure.
and do have a great weekend.